If you can just put extra bits in here and there and try and pay the loan off a little bit quicker, you're literally bringing your retirement forward.
G'day guys, welcome to the MTDC Lounge. This is a podcast that breaks down everything you need to know about designing and building your ultimate home and what to expect. Whether you're a DIY renovator, a budding developer, or everything in between, we'll dive into the building journey, touching on what to expect, what's next, and how to go about it. We'll hear from a heap of experienced consultants and trades about all aspects. So let's get stuck in. Welcome to the lounge. G'day guys, and welcome to the MTDC Lounge. You're here with Matt again, and you've got tonight we've got Nick Jones. You're from Aussie Belmont, and you look after Eleonora and the Junction.
Certainly do, buddy. Thanks for having me.
Not a problem, mate. So you guys are a multi-award-winning mortgage brokerage, and you help clients, builders, developers, I guess, finance their builds.
Yeah, certainly do, mate. I've been with Aussie for about 10 years, and I've been with my business partner for the last, I think, coming up 8 years, actually, at Belmont. We opened up the Junction store a couple of years ago and did the same. We did the same with Eleanor in Queensland probably about, maybe 2 and a bit years ago, I think, something like that.
Nice one. And you guys are just smashing it, goal to goal.
Oh, mate, the industry's been nuts. We're busy as all hell, which is great. Keeping on top of things is always interesting, but no, we're going from strength to strength. We've put on a lot of brokers in the last sort of 18 months, and without sounding like too much of a tosser, we are doing well.
Fantastic. No, that's excellent. Well, it's definitely the climate to get you guys involved and start looking at this, the builds. And I mean, we're going to go over that tonight, and I'm going to ask you a few questions, and hopefully we can get to the bottom of what makes you guys tick, and what can the developers and the buyers do to get a good broker, and how do they achieve it?
Yep.
Rock and roll. So I guess where do you come in? Where do you come into the system?
As early as possible, right? I say it to people all the time. We're only just talking about this outside before. I was waiting for you when you were on the phone, rudely. As early as possible, right? You can't do anything without finance. That's just the reality of it. You need to be talking to, I'll say broker, I suppose bank if people deal with a bank, but that needs to be the first thing you do. There's no point wasting your own time getting your hopes up for whether it's a small renovation at home, whether it's a full, development, whatever you're looking at doing. Finance is the most important thing. So I'm always stressing to people, it's like, if you have any plans, any ideas, just call us, have a yarn. I'm always happy to catch up with people and just start that early process, because even if people can't do something today, but they have a cool plan in mind, you look at it and go, the plan makes sense, but you can't do it because, I don't know, your missus is on mat leave, or you haven't paid off that car loan yet, or your business isn't quite at this point that we know it's going to be in 12 months, we can set that plan in place. And that's easy from our own. Like, running scenarios is actually what we enjoy doing. I'm forever going out to people's houses. I did this 3 appointments in a row yesterday out at people's houses across Newcastle. And all 3 of them are like, oh, look, I'm sorry, we feel like idiots getting you out so early. And I'm the guy going, you're not wasting our time. This is my job. This is what we're here to do. And there's some people who have been dealing with for years, and they haven't got across, for whatever reason. They might have changed jobs, or again, started a business, gone out on their own, or whatever it may be. But starting that process at least gives people that understanding of where they need to be from a financial perspective, because you can have all the best plans in the world, pun intended, but if you don't have the cash to pull it off, what's the point, right?
Yeah.
So, I'm very big on setting that expectation right from the get-go.
That's amazing. And so would you recommend any clients come to you with plans, or what happens if they don't have plans at all, and then they just say, hey, listen, we're in the ballpark, or what can we even get?
Yep. No, it's before plans, 100% before plans. I mean, my first question always is, how much are you going to need, right? And of course, no one really knows. I've been going through this myself with you guys. You're welcome. I don't know how much it's going to cost me, but you at least need to look at it and go, can we borrow anything? Because that's going to change what you do, right? Whether it's something as small as, look, we just want to, I don't know, put a deck on, extend, put another bedroom on, whatever it may be, at least you know where you start. If I look at someone's borrowing capacity and go, you can borrow an extra $40,000, then they might go, okay, we're going to put a new kitchen in and that's it. And they're not going to go any further. You look at it and go, actually, you've got a bucket load of equity, you've got plenty of borrowing capacity, they're happy with the repayments. You might do a better debt consolidation to free up some cash flow, but at least you're getting in nice and early before you get to that point again of, I say wasting time. It's not so much that. I'm always very paranoid about people getting excited about what that next step is, and then they just can't pull it off.
Yeah, I guess like on that, it's going to set their expectations, right? Like you turn around and say, hey, you're only going to be able to afford a $300,000 loan for a construction loan, and then they're going to go, well, that's not kind of what we need, or even better yet, it'll even get when they come in to see us or get their team around them, they're going to say, hey, we've only got $300,000 to spend, and then we can start designing.
Well, I mean, you can work to a budget.
That's right.
Yeah.
So
it's nice when it goes the other way. It does happen every now and again. It's like, yeah, actually borrow whatever the hell you want. People are like, okay, fantastic. We're going to put a second story on and we're going to do this. And buying investment property doesn't happen all the time. Borrowing capacity is a bit tough at the moment with the rates being so high, but on the odd chance it does, it's quite nice.
Yeah, no, it's a great thing to watch too. So what's the biggest myth about the mortgage brokers that you wish that you could crush?
Biggest myth about mortgage brokers? I don't know, man. What is the biggest? I mean, people don't it's probably becoming better known now, but most mortgage brokers are actually paid a commission from the bank when the loan settles. So most of us don't charge a fee. There is a bit of a lot of people know that these days. When I started as a broker 10 years ago, a lot of people didn't know. So they would just assume that they had to pay us something. Through Aussie Home Loans, we don't, right? We're paid a commission from the bank when the loan settles, and Aussie takes a cut of that and then it works its way through to us. But people don't have to pay for our services. I will, and because it's not part of our business, I forget about it. Every now and again, I'll sit with someone in the office for an hour or two or in their lounge room or whatever, and then I get up to leave and they're like, well, what do we owe you? I'm like, oh shit, sorry guys, I should have mentioned from the start, you don't owe me anything, you never do. He's sitting there for 2 hours thinking they owe me some money, which they don't. So that's probably the biggest myth. I mean, talking to, again, I live in the Aussie world, but most brokers operate the same, is that you can just talk to a mortgage broker. We're not like solicitors where we charge for every email or phone call, or accountants where you have timed, income and that sort of stuff. So that's what I say to people all the time. It's like, it costs you nothing. Pick up the phone and ring a mortgage broker, preferably me, but it's why wouldn't you start that process at the start when there's no cost involved? So that's probably the biggest myth.
And look, like I've run my mortgages through you. You're welcome. And everything that we've done, the process has been super easy. You've got an app that we can log into, and we follow everything through that as well. Another benefit that you guys do is you send us a box of cookies every birthday.
You're welcome.
They're beautiful, but there's a lot of benefits that I've found just on a personal level working with you guys, and I guess putting out a mortgage through you, and we've found the process super easy, and you've always been available.
I appreciate that.
Now, I mean, when we get down to the nitty gritty of buying or building and everything like that, the biggest thing that's going on at the moment, first home owner grant is coming through. That's it. Got it there. It's coming through, and it got brought in early. What do you wish these guys knew before they did it? What's their best avenue? How can they do it? Does it apply to building and construction? Does it apply to ownership?
The biggest, and again, it's another reason why people need to get out and talk to the mortgage brokers, or talk to a mortgage broker, because if you go online and have a look at some of this information, I was doing it today for a client, you go on some of these government websites and they're almost impossible they're very black and white, right? And life isn't. So you need to understand, income thresholds and price caps and all those sorts of things. So the one that you're referring to is the home guarantee scheme. So that was going to be rolled out at the start of next year, and they brought it forward to the 1st of October. And it's generated a huge amount of interest, which is great for us. The phone doesn't stop ringing, but anyway, it's a good problem. So basically what happened before is there is income caps on, how much you can earn as a single applicant, how much you can earn as a couple. And then there's also price caps as well for certain areas. So locally around here, the price cap was 900,000. What's happening as of the 1st is the price cap is increasing locally here to over $1 million, $1.5 million, and the income caps are completely disappearing. So what that means is that people that were earning as a couple over a couple $100,000 a year that weren't previously eligible for this scheme means they're going to be able to get into the property market sooner, which is great. And the scheme it's the federal government scheme, and it allows you to buy a property with a 5% deposit, which is a massive one, because it means that people obviously don't have to save as much. So it's generating a huge amount of interest at the moment. It is a separate scheme to the New South Wales government stamp duty waiver. That's a separate one as well. But again, it's a reason why you do want to be talking to a mortgage broker. There's things to remember too. When the income caps were there, it was worked off last year's income. So a lot of people didn't know. You had to have your notice of assessment. It's the one document that the government required. And the banks sort of administer these grants, or not grants, I shouldn't say, administer the programs, right? So the banks have their requirements, but it's actually coming from the government. So the main thing was a lot of people previously didn't know about these income caps. And again, he verified it was with last year's notice of assessment. So if you got to say January this year, I'd have to ask for the 2024 notice of assessment, and the income threshold depended on that. That's the sort of thing that's hard to work out on your own, because you might be earning over the cap so far this financial year, but last financial year under the caps, you're actually eligible. So there's small differences like that. But again, the big change is those income caps are disappearing.
Yeah.
Which is great, because one frustrating thing of that scheme was that you need to be able to we need to have a certain amount of money to be able to afford a loan, right? I need to show a bank that you can service the debt. With property prices the way that they are, is to be eligible for the scheme, you had to earn under a certain amount. And then I'd go, that's great, you're eligible for the scheme, which means you can only buy a house that's $200,000 under what you're looking for in the particular area, which means you go, great, I can get a spot in this scheme, but I can't do anything with it. So that was a bit frustrating. So they're the changes coming in from the 1st of October.
Yeah, so you touched on it a little bit there. You mentioned that there was multiple schemes there, and there's some words going through the developing world at the moment that, there's multiple schemes going out, and a few of them sound quite attractive for the new homeowners and things like that. Particularly the no LMI, no mortgage insurance, which is fantastic. And then there was I think there was another one where the government can get involved with the
there's shared equity, which is a big one that's talked about a lot at the moment. There's been a few pilot programs run at a state level and a federal level, and this is probably the biggest thing to remember, is that you've got a couple of different levels of government, and they're all different. They've got different requirements, and obviously we've got the story in Queensland as well. So we've got state-based schemes that are different in Queensland than what they are in New South Wales. But there are, there's the 2% one for families. There's the shared equity that's being talked about a lot at the moment. There's more information. Apparently it's on its way at the end of 2025, which hasn't quite come out yet from the government. Then there's the home guarantee, which is the one you're talking about where you've got no LMI. The other thing that's a wicked sort of part of that no LMI, I hate mortgage insurance, right? It's great. It allows people to get in and buy a house with a smaller deposit. I understand why it's there and why it's in place. I appreciate all of that. I've been dealing with it for years, but it is a cost to people getting in the market. It's not always just first home buyers, but it does particularly hit first home buyers pretty hard. So the fact that you can go to a 95% lend, not have to pay lender's mortgage insurance, is a massive saving. But another real key thing from it too is that traditionally a bank would charge more if you're above an 80% lend, right? So if you didn't have a 20% deposit, so say you went to a 90% lend, you had to pay some mortgage insurance. That sucks, but it is what it is. But you'd also get slogged with a higher interest rate, typically. That's not the case on these schemes. You get the rate as though you're at an 80% lend. So you actually get a better interest rate and no lender's mortgage insurance as well.
And it sells itself, right?
Yeah.
Everyone
loves government money, bro. Come on.
Free money, right? But how do you help the clients balance their expectations with their finance versus the construction costs?
Yeah, it is a hard one. And look, this is felt across the country, right? It doesn't matter whether you're buying an existing property, whether you own a property and you're looking to do some renovations, whether you're just starting a new build from the get-go. It is hard because very few people I'd go, this is your borrowing capacity is X, Y, Z. Through COVID, it was the other way around. But at the moment, no one goes, oh my God, that's a lot more than what we thought. So it is a bit of a hard one. I met up with some clients yesterday and look, they've got borrowing capacity. And I was going with a pretty positive approach. Like, guys, you could do something. Like in my world, if you could do something, that's actually fantastic. Realigning expectations is difficult. Because again, we're all human, right? People get excited about their new build or the work they're going to do or whatever. And that's cool. And so they should. They deserve to be. People work hard for these things. But it is hard to align that expectation.
Everyone has a budget, and that's one of our things that we have to try and push through to our clients every time they come in. Everybody has a budget, and we always have to work to it, which is totally cool. So, what's the difference between going through a mortgage broker and using a bank?
Super good question. The first and most obvious thing is people are shopping around for rate, which is important, right? Don't get me wrong. It is my job as a mortgage broker to get you the best deal. But I never put rate at the sort of the peak of importance. There's obviously fees to look at as well. Does the product suit? There's loan terms. There's a lot of these things come up with refinancing in particular. The biggest difference, of course, is that we have access. Like we've got over 25 different lenders that we deal with. You go to a bank, you're dealing with one bank's policy. That's it. And I don't want to rag on banks. I do. I'm a mortgage broker for a reason. I don't love them. But the issue is that, and I could sit here all night and talk to you about the difference in policy. We've spoken about before, like self-employed's a huge one, right? There are so many different policies that even just between the big four banks you've got on the top and how they'll assess a self-employed client, whether you've got business debts, whether you don't, will they add back depreciation? interest, instant asset write-off, all sorts of things, wages, company wages. There's streamlined policies now to allow people that are self-employed to not have to provide full financials. Like St. George and Westpac, you use a notice of assessment. You don't have to provide full financials. There's just a massive difference between how a bank will assess your loan through their credit policy. And banks go through phases too. Like they might introduce a new policy and then everyone goes, oh my God, that's amazing. And it might stay in place for 2 years. And they might, for whatever reason, they might change that policy. And then all of a sudden we're dealing with a different lender because their policy suits someone a bit better. Yep. So the biggest difference is policy. And you'd be surprised, like I said, between the big four, one that really stands out again is self-employed, but they're all very different. They'll also lend different amounts of money, right? Because you've got the way that a bank assesses how much money they'll lend is they put a buffer on top of the actual interest rate. So when we're looking at, I might sit down and go through a Commonwealth Bank calculator, compare it to a Westpac and an ANZ, NAB, Macquarie Bank, ING, whatever it may be, compare the calculators and they're all different. It's not like, you sit down and go, well, you can borrow 750,000. That's what every bank's going to give you. They're all different. And again, that comes down to the assessment rates they use, what the actual interest rate is, how they'll buffer up car loan repayments and all those sorts of things. So back to the original point, I think the biggest difference is, I talk about credit policy all the time. It's a part of my job that I do enjoy. The biggest difference between going to a bank and having one product and going to a broker and having, again with us, it's over 25 different lenders that you can look at. And they've all got different products, is that key difference. You can pick and choose, or we can, helping our clients.
Yeah, well, a bit of a plug for you, even on from me. I mean, one of the benefits that we've seen by using you, and a lot of my clients by using you they've noticed that, if things are going a little bit pear-shaped with their interest rates, you actually take the initiative in calling them and try and help them find a better rate and try 100%. And refinance, which is a game changer. And I think that's a huge thing to offer as a mortgage broker, to always be, client first, to try and find out whether or not you can get them a better deal. So that's a kudos to you, mate.
Well,
you
thanks,
do a great job.
Appreciate that. Don't talk me up too much. My head won't fit in this room. It is a big part of our business. And remember, and again, just ragging on banks for a hot minute, but we're small business owners. Like my business partner and I, we own these 3 stores. It's us, it's our brokers, it's our staff. We're not a big bank, and we're a franchise model. So it's not like Aussie Home Loans will just pay me a wage or whatever. It's not how the structure works. A bank is different. And I'm not saying that all people that work at banks are bad people, but they typically will get their wage and they can go about their life. This is our business. Do you know what I mean? Like it's like your clients, right? You've got no choice but to look. Even if you're in a shit mood, you've got to answer the phone. Even if it's 9 o'clock at night, you've got to answer the phone. You've got to respond to the email, even if you're really under the pump, because buying and building and the construction process, it's all stressful, right? It doesn't matter how smooth a build may be. There's so many moving parts. It's always going to be somewhat stressful. So again, another key difference is that when you're dealing with a mortgage broker, it's like that is typically that person's business. So they are really trying to help you out because, it's word of mouth. They're trying to protect their reputation. They want to do a good job, and they probably aren't sleeping at night if your loan's not approved. That's the world that we live in. That's why I always look so freaking tired. Bit different if you're dealing with a bank.
G'day guys, just quickly, if you're finding this podcast info relevant to you, then I'd like to quickly talk to you about what we do at MT Design Collective. You hear us talk all the time about the importance of solid, detailed home design practices so that you're not left with extra fees, delays, or unexpected costs in building your ultimate home. Here at MTDC, we design homes and provide plans that builders love to build and councils love to approve. If you're looking at a renovation, a new build, or alteration, then we'd love to help you work out the next steps forward. Book a free, no obligation chat with us, and we'll come out to your site, as it's the only way to truly get authentic, no bullshit advice. Link is in the show notes. Okay, back to the show.
You touched on a little bit just before, in your rant just a minute ago.
Yeah, told you I'm good at
it. You mentioned just before that, the biggest thing that's kind of sticking in your mind at the moment is those self-employed people. How do you help not just the self-employed people, but the people who are more of the non-traditional people that you need to help finance for a construction loan or a new build?
Yeah, it's a super good question. I'd probably start by saying what used to be considered a non-traditional loan is maybe not non-traditional anymore. So for example, and you just touched on it, I'm glad you reminded me, is the director's wage policy, right? So in the last probably 2 years, banks have made, and I'm talking about the big banks, so mainstream banks, so competitive rates. I'll come to sort of more non-conforming lenders in a sec. But big banks have made a lot of changes coming out of COVID and how they assess self-employed clients. It was sort of needed, right? So you think about it, a lot of people know that if you're self-employed, you need to provide the last 2 years tax returns. If you're a sole trader, it's just your individual tax returns. If it's a company, it's your individual, it's the company, it's the financials, your notice of assessment, the whole shebang. If you've got a partner and you pay them a wage in the business, and it's their tax returns and all that sort of stuff. So the last 2 years, you think about that. I know COVID was a long time ago, but if banks need the last 2 years coming out of COVID, if people are in lockdowns and that sort of stuff, and their business might have been traveling on well for 15 years, and then they're hit with lockdowns and all those sorts of things that we all went through, then those last 2 years tax returns look shit, right? You can't do anything with it. So fortunately, the banks made a lot of changes coming out of COVID. So I'll rattle off a few, but I won't do too many because we will literally not leave here because this is the part I really enjoy. Director's wage is a great one, right? So for years gone by, we always had people sort of come and hit us up and go, look, I've got my own company and I pay myself a wage and I pay myself, 120 grand a year. Here's some pay slips. You pay slips from zero and all that sort of stuff. That's a piece of piss. And we've always had to say, look, sorry, it's your company. So really the bank's not going to look at like it's your wage. It doesn't make any sense because at the end of the day, you can basically pay yourself whatever you want. That has changed. So there are a few lenders out there now. NAB and CBA are probably, I would say, the best at the moment, where if you do have a company and you pay yourself a wage, we can just provide that individual tax return to show what the wage is, which means you don't need to include any business liabilities. So you ain't got any truck loans or business loans or anything in the business, credit cards, those sorts of things. You don't actually have to include them. And it's all above board. Like you're not hiding debt or doing anything wrong. It's just that the bank has sort of streamlined these policies to go, right, if you're paying yourself a wage and been managing to pay yourself a wage for the last 12 months, then obviously your business is doing okay and off you go. There's certain limitations around it. Like most lenders need you to be in 80% lend, so not in lender's mortgage insurance territory. So that's a big one. The notice of assessment one I mentioned before too, it's a streamlined policy with Westpac, St. George, Suncorp also have it, where you just provide your notice of assessment, which is a document the ATO sends back once you've submitted your tax return. So that's another good one as well. You don't necessarily have to provide the full set of financials. It means that and again, it's not about hiding information. The banks have sort of looked at these policies and built them around how do you make things simpler for businesses that are in a good spot without putting that burden of go to your accountant, get me the last 2 years tax returns and all those bits and pieces. So there's been a lot of changes that have come through in the last couple of years, which has been amazing for people that are self-employed. But what it's meant is that people, again, back to your original question, people that have thought that it would be a non-conforming loan, it's actually not. Like I did a loan for a guy probably about 6 or 12 months ago. He had a pre-approval. This will blow your mind and infuriates the hell out of me. He had a pre-approval through with a different broker through a non-conforming lender.
Hang on, time. So what's non-conforming before?
Oh, I mean, it's out of the box lenders. It's typically non-bank guys like Pepper, Liberty, Latrobe, those sorts of guys.
Right. Okay.
And they'll do things. They do normal loans. They've got prime loans for clients as well, but they'll do a lot of out of the box stuff, right? So maybe people have credit history issues or short-term casual employment, short-term self-employed, those sorts of things. So more lenient than normal banks is the way to think about it. So this fella come and see me, and he had a pre-approval, and he was a first home buyer. So back to what we were talking about before, he was eligible for the home guarantee scheme.
Yeah.
But this particular lender that he had this basically a low doc loan. It sort of wasn't really low doc, but he kept calling it low doc. They weren't signed up for the scheme. So he was paying mortgage insurance at an insane interest rate, like 7 or 8% or something, like it was crap. I just said to him, look, mate, send me your financials. Let me have a look at it with fresh eyes, because you've had your business for a couple of years. You're telling me it's all going well. You've got a shitload of savings. Like it's not stacking up that your business isn't doing well. From what you're telling me over the phone, this sounds like it should be all right. Anyway, sends me all the financials through. I had a look at it and said, mate, we just need to go to a bank that uses your most recent year. Like you've just been building. It's not like, well, there's anything wrong with the prior year. We'd need the most recent year to service. So I had a look at that, and we ended up doing the loan. I think it was with NAB using their most recent year policy. And he managed to avoid his lender's mortgage insurance and get about a 2 or 3% better interest rate in this low doc loan and this accountant's letter BS that this other broker had looked at. So again, people will assume that they need an out of the box lender or a more lenient or low doc or whatever it may be, but there's a lot more lenient policy out there for people that are self-employed, which means that the traditional low doc loan is maybe not sort of required, which is great.
So the low doc loan means that there's not much information required or anything like that.
Yeah, 100%. And they've been around for a long time, and they, like I said, they do exist and they have their place in the market. I understand that, but they're expensive and they're not ideal. The most important thing is, if you're going to do it, you're doing it for a short period. But I've seen people that get signed up on these loans, and life happens. You 5 years later, you get charged 3% more than your mate for no particular reason. It might have suited you at the time, but if you don't do anything about it, you don't refinance elsewhere, your broker doesn't reach out, the bank doesn't give two hoots about you, you're paying an absolute fortune. So again, they have their place, but long term, they're not an ideal option.
Yeah, well, you just save this bloke tens of $1,000s probably.
Yeah.
Maybe, tens, maybe even
Huge.
100,000.
The mortgage insurance in itself was 20 or 30 grand or something. 100%. It's like nuts, man. And I went over my work about 45 times to make sure I had this right. And I'm like, no, I have this right. I've been doing this for 10 years, right? I don't have this right. Yeah. And when I rang him, I was like, mate, what the heck was going on before?
Yeah.
So low doc is stuff like you can rely on the last couple of quarters of BAS and provide nothing else, provide an accountant's letter, those sorts of things.
Yeah.
But again, there's mainstream lenders with competitive interest rates that are up with the government guarantee schemes, all these sorts of things that don't require as much information. So people can fit in different spaces that they may not have 2 years ago as self-employed.
So we're talking a lot about the self-employed and the director's loans, but what about the guys that are working on commissions or part-times, or have the maternity leave, or just fresh had a baby, or how do you handle that, or how can we tell the guys who are doing the new homes and all that? Is there a way that these guys can break into the market?
Yeah, it's a really good point. Like a lot of the guys that we deal with around here, they're typically younger couples for whatever reason. And a lot of them it's just sort of is how it is around here. You might have boyfriend, girlfriend, partners, husband, wives, whatever it is, and she's a teacher or a nurse or something like that, and he's a tradie of some sort. That just seems to be what a demographic is around here, right? I deal with a lot of clients that are sort of in the maybe early mid-20s. And then, you've got mum then goes on mat leave and those sorts of things. So mat leave is a really good one. I'm glad you brought it up. There's a lot of people that will assume because they're on mat leave they can't get a loan, which is not true. There's some important things around it. You need to be careful. You can't just sort of go, yeah, here's your money, even though someone may not be going back to work for 6 months. There's certain things that we need to show the lender that when this person returns to work, they're going to have a dependent. They're not going to return to work full time. Let's be realistic. They might go back 2 or 3 days a week. But as long as we can get some confirmation for the bank, which is traditionally a letter from their employer saying the female applicant's going to go back to work in 3 months' time. Yes, there's a servicing shortfall for that 3 months, but they might have $10,000 or $15,000 sitting in the bank account. Then most lenders will actually go, okay, that makes sense. Got a letter from the employer saying they're going to go back to their, say, permanent part-time role 2 or 3 days a week, and they'll work the borrowing capacity based off that. It's a really important one because there's a lot of people go, oh, look, I don't think we're going to be able to get a loan because I'm on mat leave, or my missus is on mat leave or whatever, and it's not the case.
So the biggest important point there is just don't give up on that owning a home dream yet. Like,
don't give up on it, man.
call your broker. It's
all that shit you see in the media all the time, right? It's this whole thing of first home buyers can't get into the market. I've been doing this for 10 years, and the bulk of my clients are first home buyers.
Yeah,
that's what they are. They're just aspirational people that go, I want to get a house, and they say, oh, I saw something on Facebook that says I can't get it. One thing that pisses me off, I remember seeing this is a while ago now, something on Facebook along the lines of, oh, look, I couldn't get a home loan because of my gym membership. It's like, yeah, your gym membership and your bankruptcy that you're not putting in your Facebook post. Like, come on, that's not legit. You know what I mean? You're allowed to live a life. A bank understands that you're going to go to Subway, that you're going to do this, you're going to have a gym membership. As long as they can have a sort of a holistic view of it, which is where we come into play, and you sit down with somebody, go through their living expenses and make sure those details stack up with their financial position. As long as it all works, the first home buyer can get in the market. Yeah, you've got to have a deposit. And if you don't have a deposit, maybe you do a family guarantee with some parents that are happy to help out. You need to have the income to do what you're going to do, but first home buyers can definitely get into the market. Do them all the time.
Yeah. And I guess when you're funding the clients, is there a way that you specifically help them do stage developments or construction loans?
Yep.
What even about multi-dwellings? Like, have you touched on the multi-dwellings yet?
Yeah, we do. It's again, you've got to be really careful around which bank you're dealing with. Straight off the bat, there's some banks that just don't do construction. There's some banks that I would say aren't great at it. The really obvious thing, it might sound like a small thing, but a lot of banks need to do an inspection at every single progress payment before they'll release funds to the builder. And then there's other banks that only need to do it at the first and last one. And again, there's sort of the bigger banks that are a bit more lenient when it comes to construction. There's other banks that will only do a single dwelling. There's some that were happy to do a duplex. There's some that will go up to 4 properties. Well, if you go anything above 4, you're typically moving into the commercial space, which we do, but we just don't see a lot of it. A lot of the stuff that we do around here is say maybe people from 25 to 45 in that sort of range that are maybe doing a subdivision, small subdivision or knockdown, rebuild, those sorts of things. But again, it is really important to know the difference between the bank policy, which is where a broker comes into play. It's what we do, because some banks will look at it and go, no, we're not going to be happy with this, or you're over this threshold, you need a QS report or whatever you may need. And then there's other banks that are a bit more lenient on that as well.
Yeah. So is there a better way to structure a certain loan? Like if you're going to do the construction loan, or if you're going to the bank for a loan, is there a better way if they're going to do a knockdown rebuild or a reno or even a new build? Is there a better way to structure these loans, or is there something that the client should be aware of prior to coming to you that they should be aware of?
Yeah, definitely. There's a couple of things that has come to mind straight away, and this is just real. It might seem like small stuff, but it's so important when you come to the crunch. Paying a deposit to the builder is a big one. So, for example, if you've got an existing property and you're going to knock it down and rebuild and do whatever you need to do, you need to have that cash flow up front to be able to pay for, I mean, it's not just things like plans and all those sorts of bits and pieces. When you get to the crunch and they need a deposit at the start, the bank may not necessarily be funding that until the project's out of the ground, but the builder may want something to start, right, which is understandable. So from our perspective, understanding that, and we work quite closely with builders as well, but understanding that process, that payment process is really important, because a lot of people sort of, and I get it, they go, yeah, this is what we're going to do. Got the equity in the house. We're all good to go. It's like, yeah, but you do. But think about it in practical terms. You actually need to have the deposit to pay the builder. So and it sounds like a real small thing, but we run into that all the time.
Especially if it's like 10% or something. This is $70,000.
Yeah, exactly. Most people don't just have it in their bank account, because if they're doing this, using the equity from the property. It's like when you buy an investment property, if it's not construction, you buy an investment property, you might be using the equity from your house, but how do you pay the deposit when you're securing the property? Absolutely. You can organise deposit bonds and those sorts of things. Most people don't even know they exist. It's like there's that practical part of just making the transaction work in that structure.
I'm going to ask you about the deposit bonds, right?
Is it on your list?
No, it's not. But what's a deposit bond?
Deposit. No one knows what deposit bonds are. I mean, two of them yesterday. Yeah. No one knows, but they're used quite a bit. The easiest way to explain, I suppose, is that a bond sits in place of a cash deposit. And using a family guarantee is a prime example. So with a family guarantee, you're typically using a family member, usually mum and dad, but it can be other family members, equity in their property as your deposit, basically, right? Using the equity out of their property. But which means you may not have a huge amount of cash. You still need to have some cash. I can't go to the bank and say, here's a couple with $0 in their bank account. Can you please give them 800 grand with a family guarantee? Technically it works, but the bank's going to go, well, piss off. They haven't shown any savings. This isn't responsible. And I understand that. Yeah. So they've typically got some money, but when you're buying a property, you're normally exchanging contract or a block of land, whatever it may be, with a 5 or 10% deposit. You actually need to have that money. But if you're using mum and dad's equity, it's like, where's that money come from? And that's where these deposit bonds come into play. So you actually buy a bond. You've got to pay for it. There's different bond companies out there, and it's separate to your loan. But you buy this thing called a deposit bond and pay for the deposit bond. It sits in place of your cash deposit. It allows you to exchange contracts. So secure the property, take it off the market until settlement. When settlement rolls around, then you're getting the loan from the bank, which makes up all that, and you finish up with the bond. Yeah. Same sort of thing happens if you're buying and selling. You might be using the equity in your house to buy over here. You don't have the cash, using the equity. But the real estate agent's going, where's the 5%? Put it in my bank account, because you want to take the property off the market. You need the deposit bond to do it.
Yeah, well, and so again, like this is such a Pandora's box, right? I've got a million questions for you.
Got all night, bro.
so I mean, at the moment we've spoken a lot about just standard loans and things like that. But you did touch on quickly, like the investment loan or the investment cost. So there's obviously an investment loan and a standard a PPR loan and things like that. Walk us through that.
The differences between them. Interest rate for starters. A bank would charge more for an investment loan. So there's a whole bunch of different products out there. Banks have owner-occupied loans, investment loans. They've got basic products, and this is most lenders. Every bank's a bit different. We've got to remember, I say this to people all the time, a bank is not really lending you money, they're selling you money. Do you know what I mean? So they've got different products. It's no different to going to a car yard, and there's different cars, and there's different features you can have and all that sort of stuff. So banks typically will have the basic product, they'll have a package product, and you can have the same for investment. You can have a basic product package. Really the key difference is that you can have in a variable rate package product, you've got an offset account. Most banks in the package product, you don't. You might get a credit card with no annual fee or some cheaper insurance, whatever they're promoting at the time. And then, of course, you've got investment loans. You can have the same thing, basic and package on investment. And then in the mix of all that, you can have principal and interest repayments. You can have interest-only repayments as well. Getting the structure right for investment, and getting the structure right in any loan, of course, is important. You don't want people sort of getting ripped off. But or not having something that really suits their needs, but getting something right with investment is really important. You really want to be maximizing, and I'm not going to give financial advice, but of course you want to be maximizing your tax position, all those sorts of things. And that's why it's important to get that structure correct.
Yeah, it's also important to mention that people have their own certain circumstances, and they all have to do their own research as well.
100%.
This is not a one size fits all conversation. This is do your own research.
Yep.
Find out for yourself what suits you. Give Nico a call and give him grief for the next 10 days at 9 p.m. at night, and I appreciate that.
Do you know the biggest thing with that, what suits people too? I mean, obviously the financial stuff's important. People need to do their research, and let's come and talk to a broker for their loan. Let's go talk to their accountant, their financial planner, or whatever. But everyone's different with their sort of risk appetite, I suppose you'd say. Maybe that's not the right term, but some people are financially, they're just happy to do whatever. Yeah, man, we'll buy this house and we'll be fine and we'll do this. And it's fine, that all works out. Then there's other people who are just really conservative, and that's fine. And that's what works out. You need to know what you're comfortable with. And I'm forever saying that to people. It's like, I can write your loan, but I'm not paying it off. Do you know what I mean? Like, you guys need to be really comfortable with this moving forward, because for starters, I've seen people put themselves in a tough financial position, or they've been forced into a tough financial position. They've lost jobs, or, health issues or whatever. It's not nice. COVID, that old chestnut. So it's not nice. So I'm always saying to people, it's like, I can write you a loan if it works and all these numbers work, but I'm just the guy saying, yes, it works. No, it doesn't. You need to tell me if you're comfortable. If you're not, we ain't doing this. Like, let's think about something else. Yeah. Or if you are, kick on and off you go.
Well, it's a commitment, right? It's a 30-year commitment.
It's 30 years, bro. Like, I'm going to live that long.
That's it.
Don't ring me in 29 and a half years and tell me you can't afford your mortgage. I don't think I'll be around.
That's it. Well, how do you work with the builders? Because you mentioned that you touch base with the builders during the loan process and stuff. How do you work with the builders and how do you work with the designers to make sure that the clients are looked after from, I guess, from
look,
the work?
it's everything in this game is relationship stuff, and you understand that. It's the same. It's the same with your industry, right? There's a lot of overlap between the two. It's no different if someone's buying existing property. I like to deal closer to the real estate agent. If it's investment property, I like to know the property manager. Just have a quick conversation with them, know what's going on. If they're buying a block of land, it's important to know what's going to land, when's it going to be registered, all that. Talk to the agent, usually works the developer, and just get a good understanding of the timeline, which is important. And the builder's vital, hey? And it's not so easy. Like, a lot of builders just, I don't want to be rude, but a lot of them are just like, was the money there or not? You know what I mean? Like, we're good to go, which is fine. And that's what they need to know. But just having a clear understanding of the timeline, because there is just so much going on that even if you've done a build before, a lot of people deal with the first home buyers or first home builders. But it's really important to know that process, because they'll go and talk to a builder, and then they might go, say you go to, I don't know, a big developer or big builder, and you go talk to the salesperson. So that's all well and good, but will that house really fit on that block of land? Do you know what I mean? Or will there be issues with the sloping side or wherever it may be? Then when they actually dig a bit deeper into it, it's like, shit, that house that will sold on Saturday actually doesn't fit on this block of land. So it's having all those sorts of conversations with people and go, yeah, I know you just got told by XYZ homes that you're going to be able to build this dream home. Looks amazing, like, thanks for sending it through, but you need to go and talk to the actual builder. Like, go to the next step and figure out if this project's really going to fit on here, because a lot of the time people go and talk to the builder and the builder goes, can't fit on there, or it can, but we're going to have to do these retaining walls here, or it's going to be sloping slide, or if the house has to be stepped, or whatever it may be. So that component of is really important, and just getting people to talk to the builder. We talk to builders through that process, but I'm normally doing it through the clients. You know what I mean? It's like, hey guys, go ask these questions. Like, you really need to know about this. Like, out of contract items, that's a really big one. A lot of people don't know that not everything is included when you build a house. Your driveway may not be included, pools not included, landscaping may not be included, floor coverings, window coverings, air conditioning, the whole shebang. And people need to know that. You know what I mean? Like, floor coverings is obvious one. People go, what, I don't have carpet? It's like, well, you might. But if it's not in there, we need to make sure it's covered. Do you know what I mean? So that open communication with the builder is really important. I always need to get clients' permission before I just go and start talking to builders, but really need to know what that process is before we just kick on and go, here's the house you're going to build.
Yeah, absolutely. And like, you're touching on an incredibly important point. Over the last couple of weeks while we've been running these podcasts, every person that I've spoken to...
We've been doing this for years, bro. You seem like such a natural.
Everyone that we've spoken to, one, communication's key. That's the common theme.
Yep.
The next common theme is quotes.
Yep.
What do you tell your clients?
Yep.
To look for in a quote? Like, don't come to me with 4 lines of percentages. I want to see what do they want to see? What do you want to make sure that those clients are seeing before you hand over money?
Yeah. So when it comes to when it's the whole build, right? Not just out of contract items. When it's the whole build, there's certain requirements that a bank will have, like normally following what the HIA standardized contracts have. But quite often builders will change around. You know, they might not even got builders, they've got a business to run, but they might just be asking for a bit more money up front than what the bank's comfortable with. And again, every bank's a bit different on policy. So it's not unusual for me to be looking at a build contract and go, that doesn't suit NAB's policy. You know, you're going to have to go back to the builder, and we'll put all that in writing and send it to the client and send it to the builder and explain why. We don't just sort of go back to your builder and have a yarn with them. But that's a really good example, is where you might have a contract that the bank feels is a little bit too front end loaded, so that you've got to go back to the builder and get those sorts of things adjusted. And I say to people all day, it might sound a bit dickish, but I say to people all day, it's the banks are the one who have the money, right? So we need to adhere to what their credit policy is. So there's changes that we sometimes need to get done to those contracts. I always think it's in the best interest of my client, right? So I'm always going, look, guys, we want to make sure that we get this right. It needs to be right to get loan approved for starters. We want to make sure it's right to protect you. That's why you have progress payments and all those sorts of things through there. But when it comes to quotes out of contract items, that's always a hoot, right? Because if you're buying land that's maybe unregistered, it might not be registered for a couple of months. You've gone ahead and got your build sorted. You picked your dream home. You've got your tiles. You've got the colors. You've got your light appointments. You've done all that sort of stuff. The house is fantastic. Then you need to go get quotes for your driveway and, you know, all the out of contract items, your landscaping and your turfing and all those things. And they add up, right? Like a lot of people just go, oh, we'll just pay for that in cash when the time comes. I'm like, guys, you're moving into a new house. Like you're going to want furniture. You've got to live in the meantime. This shit's expensive. I always say to people with the quotes they're getting, just remember that you're not going to be putting your driveway in for maybe 6 or 8 months, maybe 12 months, depending on when your land's registered. Your driveway quotes, especially after the whole COVID bump with construction costs, your driveway is probably not going to be the same cost in 12 months' time.
No way.
Do you know what I mean? It's just, you know, things have stabilized a bit now, but going through that period, I was saying to people, it's like, go get a quote. Make sure it's an expensive one. Like make sure it's a really thorough one where someone's come out.
It's got everything in it, right?
It's got everything in it. It's got everything. I'm not saying get ripped off, but it needs to be a thorough quote. Don't just do someone that's going to write in the back of a napkin and say, oh yeah, driveway, I'll do it for $5,000. Because when it comes to crunch, you want to put your driveway in. If we've got your loan approved and the bank thinks that you only need $5,000 for the driveway, because that's the quote we've provided, comes to the crunch and you need 25.
Yep.
And that happened, right? Coming out of COVID.
They're footing 20 grand.
Yeah, well, the bank would go, yeah, we'll give you 5.
Yeah.
And the bank will only hand over the money when it's done.
Yeah, absolutely.
So you got to come up with the other 20.
Yeah.
And it's like, if your house isn't done, the bank's not going to lend you any more money, right? You may be tapped out in borrowing capacity and all that sort of stuff. So the out of contract items is a really important one, because people will just assume, and rightfully so, that's I'll just get the cheapest quote to make the whole thing look as cheap as possible. And I'm the one going, no, you need to build a house. You can't just have the cheapest thing at the end.
Yeah. Like there's always going to be a budget. There's always going to be like cost savings and things like that. But more importantly, you got to make sure that whatever you're paying for, you're going to be covered the whole way through. And it's so important to make sure that quote again is completely thorough and covering every point.
100%. Yeah.
So a real juicy question I've been waiting to ask you all night about.
Oh, here we go.
What has changed in the last 12 months for lending since COVID? We've seen that massive hike up to try and level out the prices and the percentages. Then we've started to see that dip. What are the massive changes, and what do you think is coming in the next 12 months?
In terms of construction or overall lending?
Just overall lending.
Well, mate, I've already touched on it. The biggest change has been the self-employed.
Yeah.
The biggest change. I mean, there's been more help, like we spoke about earlier, with the changes for the first home buyers, and there is a lot of support out there for first home buyers now. So anyone thinking about it needs to reach out to a broker and have a yarn with them about to see if it works for them. The biggest changes have definitely been self-employed, the change of self-employed policy. The other thing's been dropping interest rates. Right, every time an interest rate drop comes down, because like I touched on a little bit earlier, banks don't look at today's interest rates and go, can you afford $500,000 at 5.34%, right? They have to put a buffer on top, it's usually 3%. So they're assessing somewhere between 8.5% and 9%, whether you can afford the loan. And that's important in case interest rates fluctuate and all those sorts of things. People aren't going to lose their homes. If rates go up a bit, that buffer's built in. So the dropping interest rates has helped borrowing capacity a lot too. So that's something else that people should consider. If they might have been not knocked back on a loan, but told maybe 12, 18 months ago, or even 9 months ago, they couldn't afford a loan. You have a look at interest rates now. It's like you actually can, because the rates have come down. There's more affordability in the market. So that's probably been the most immediate sort of sugar hit. But again, the changes to the self-employed lending over the last 12, 18 months has been massive. The other thing, just as an industry-wide sort of change, not so much in lending, but it's people are back in construction, man. Like we went through that, which is great. We went through that phase coming out of COVID, where I know we're focused so much on that COVID crap, feels like 10 years ago, but no one, well, the construction stuff's important. No one wanted to touch a block of land for a period of time, right? Because everyone just heard builders going under and construction costs have gone through the roof. And I had plenty of people that were considering buying blocks or building houses and that sort of stuff that just went, I'm not doing this. Like I just saw on the front page of the Herald, another builder's gone under and all that. So we had some clients that went through hell, midway through builds and those sorts of things. So one of the biggest changes in construction is that people are actually back. They're going, I'm feeling comfortable now. You know what I mean? The prices have leveled off. It's not as crazy as it was. There's not the supply restrictions and all that sort of crap that we went through, which is great, right? Because we need more homes.
Yeah,
there's
absolutely.
just not enough homes.
Well, there's a massive drive for it now. So we're like, particularly in Lake Macquarie and Newcastle Council, they're getting tapped on the shoulder and telling them to start being a little bit more lenient. There's so many rules that are starting to come up now, which is going to be great. Now, I guess how, like you mentioned that the interest rates as they go up and down, it kind of affects the payments. Now, do you recommend, because there's a lot of things, because everybody's feeling obviously the cost of living pinch, but as that interest rate comes down, people's payments obviously go down. Two kind of questions there. Does
the payment may not come down?
That's one of my questions. So the question one is like, how does the interest rates really affect their payments in terms of how much it's going to cost them? And then when it does actually affect their payments, particularly if they're going down, would you recommend, if they have the space, to drop their payments with the interest rate, or would you keep it going?
It's a kick-ass question. So, and a lot of people are not aware of this. When your interest rate drops, your repayment should drop, right? That's common sense. Not necessarily the case. A lot of lenders, and I can understand why and explain why in a sec, but a lot of lenders will leave the repayment the same. Okay, so you think about the start of the year, interest rates we've had 3 interest rate drops this year, so rates are 0.75 higher. Depends on your bank and all that sort of jazz, but they were higher at the start of the year, which means say your repayment was $900 a week, and now it's going to be, I don't know, $810 a week or whatever it may be. The bank will leave, a lot of lenders will leave that payment the same unless you actually reach out to them and say, hey, can you please drop my repayment? Now, your minimum repayment would be that $810, but a lot of lenders, again, some are different, but a lot of lenders would leave that repayment at that $900. So people ring all the time, and Aussie's got campaigns, they're sending correspondence out trying to explain this to people, because a lot of people just assume that rates went up, your repayment went up. We all understand that. Rates go down, your repayment should come down, but banks don't necessarily do that. Now, not stealing your money, they're allowed to do that. Your minimum repayment has dropped, but the repayment that you're making may actually still be the same. Now, all that's happening is you're paying more off your loan. So I've had a lot of people that would, reach out to, I talk to clients obviously all the time, and they'd be going, look, should we drop our repayments? And my first question is, can you afford the repayment? Can you afford the $900 in that example? A lot of people go, yeah, look, we've been doing that for, 12, 18 months, whatever it's been since the rates went up. And I go, cool, if you can do that, all that's happening is you're paying your loan off quicker. It's a good thing, right? Like none of us want to really have a 30-year mortgage. You want to pay it off as quickly as possible. And you'd be so surprised, you muck around with calculators and all that sort of stuff, but even small extra amounts every week, fortnight, a month, whenever you do your payments, any extra amounts you've got in a loan, it just shaves time off your loan. And this is the thing I focus on a lot with clients. Like you might have a 30-year mortgage, but just because of those extra payments you make, you're doing it weekly, you're doing it monthly divided by 4, so you're actually paying a little bit off quicker, and you've got some money sitting in redraw, your loan might be 30 years long. You might have a 27-year loan term. You actually look at your how long it's going to take you to pay the loan off. You're down to 21 years. And you may not really have done anything. You might have just kept the payment the same as what it was in January before the rates started to come down. A lot of people go, yeah, okay, we can afford that. I always say to them, if you need to, if things get tight, you do have a minimum repayment you can fall back to. And that's fine. The bank's fine with that. As long as you're meeting the minimum repayment, then you're fine. The bank's not going to have any issue with the loan. But if you can keep that payment the same, even if you do it maybe just for 12 months, and then it comes down again, you are building up that bit of a buffer.
Is there ever too much extra that you can pay to your mortgage? Like if you've got an extra,
you pay it off tomorrow, bro. What are you talking about?
Well, I mean, like if does it become detrimental to your payments if there's like a certain amount that you pay over your minimum payments? I mean, like I know there's offset banks and stuff that help those payments a lot more, but I mean, cash in the hand versus cash in the mortgage, is there like too much is too much?
Does it mean paying it off too quick?
Yeah.
So with most banks in a variable rate loan, no. Fixed rates are different. With a fixed rate, most lenders will have a certain amount you can pay off. You might only be able to do an extra $10,000 a year. For say you're fixed for 3 years, depending on whichever bank it is, you might be able to do 10 or 15 grand a year each year that you do that. If you go over that, you're potentially breaking the contract. And on a fixed rate, most lenders don't let you redraw. It's any extra money you put in there, you can't actually get back. So a lot more restrictions with a fixed rate, right? With a variable rate, pay the sucker off as quick as you can.
Yeah.
Like I said, even small bits and pieces that you can get into your loan, it's shaving time off your loan. Now, you take 5 years off your loan, bro, that is 5 years retiring earlier.
Yeah.
Like most of us, if you can get to the point where you own your house, like it's a hell of an achievement when you can. I see it with people. And it's pretty fucking cool, I'll be honest with you. But you've got to get to that point. If you can just put extra bits in here and there and try and pay the loan off a little bit quicker, you're literally bringing your retirement forward. So with to answer your question, there I go again, ranting. With the variable interest rate, there's not really any restrictions. Again, some banks may, but typically there's no restrictions. Pay the loan off as quickly as you want. Any extra money you've got sitting there in free redraw, you can take it back out whenever you want. So you've got access to those funds. Yep. So to be honest with you, mate, there's no downside to paying your loan off quicker. Why would you want to give the bank a full 30 years worth of interest if you can try and pay the sucker off a bit quicker?
Yeah. Extra couple of years of equity.
And there's something else you just reminded me of too, and I see this all the time, is you got to remember that people have money in a savings account, which is great. At the moment, it's always an ING Maxi Saver thing. It's always, I laughed with some clients yesterday, they cracked up laughing and went, that's exactly where our money is. But you might have a loan with say $500,000 owing, and you might have $10,000 sitting in redraw, which is fantastic. So you're only getting charged interest on what's outstanding, but you might have $10,000 just sitting in the savings account. Now you'll see online, this is a great savings account, 3.5% interest or whatever. Remember, your home loan's always going to be higher, right? So borrowed money is always going to cost you more than what you're going to get, the return you're going to get on a savings account. If you've got a variable interest rate, you've got access to free redraw, then why wouldn't you put the money in the loan? On an owner-occupied property? Different for investment, a whole different kettle of fish. But on your owner-occupied property, pay the sucker off as quick as you can.
Yeah.
You might be earning a bit of interest over here. You've probably got to pay tax, and over here you're saving a lot more. So just get it in a loan, pay it off as quickly as possible, even small bits.
It's sitting in an offset account. It's sitting in a redraw. So
offset, they're two separate things. Redraws in the actual loan, but I see what you mean.
Yeah. So at the end of the day, like if somebody actually needs it,
yep.
Ultimately, like in the long run, I guess you'd be saving more money. But if someone needs it, they can definitely grab it.
Yeah,
man, I could go on literally all night. I could ask you a million questions. We could literally make multiple
episodes. Passionate I get about such a boring topic,
mate. I'm not even in your side, and I love listening to it because it's such a fruitful conversation, particularly for people who are developers and who are just freshly buying houses. It's like there's so much to learn, particularly in just this money side, and it's such a tender topic, and particularly when you start having this conversation and getting in the know, like it helps people, I guess, feel confident that they're making the right decision. So I think it's an awesome thing. So what I'm going to do is to wrap up, I'm going to ask you a quick couple of questions, and I'll have to get you back another night. We'll
love to, bro. Love to.
Again,
it's
mate.
Been the best.
Yeah, rock on. All right, fixed rates or variables? What do you reckon?
I hate the restriction of a fixed rate so variable.
Really?
Yeah.
Oh.
I'm not judging on where interest rates are going. I just don't like the restrictions of a fixed interest rate.
Like, would you do like
going through COVID, I was thinking about this before I was answering your last question. Going through COVID, obviously fixed rates are super low, right? There was 1.89, 1.94% for 4 years with some banks.
I think I got a 2.5, I think I got.
Yeah, you're welcome. So that's long gone. So we were splitting the loan a lot, right? So you might split, say, 80% of loan, leave 20% on a variable rate. So you had the best of both worlds. You had those really low fixed rates, which we all knew wasn't going to last forever, but with the variable rate, you still had the flexibility of making extra payments, potentially an offset account, redraw, those sorts of things. But if you just rapid fire question, fixed or variable, I hate this personally. I just don't like the bank being in control. So variable rate gives me that little bit more comfort, as in extra payments, offset account, redraw whenever I want, leave, refinance my loan without any break costs, go to a different bank, sell my house, those sorts of things.
Talk to you for another 20 minutes on that one.
It's supposed to be rapid fire.
Yeah, sorry. Offset or redraw?
Again, it depends on the situation. I prefer offset, just on the off chance that you're going to, turn your PPR into an investment property down the track, and it gives you a bit more flexibility.
Yep. What is a dream client or your nightmare scenario? What's the one thing that sticks out the most for you?
Everyone's a dream client. It's the answer I've got to give you. What's a dream client versus a nightmare? I don't know, man. Like, to be honest with you, there's lending, again, I can't talk about self-employed all night, but I quite enjoy it. So, I know that there'd be a lot of brokers out there and banks, self-employed, shit, here we go. There's more, there's more paperwork got to go through or whatever. But I enjoy that challenge. I generally do. It sounds like such a wank. But I do. I wouldn't say there's anything that's too difficult. Literally just sitting there at my table at work, at my desk with just like, here's the trust, here's the company return, and you're just following the trail of information. I actually find that quite exciting.
Yeah.
I'll be honest with you, if someone came in with 200 grand in the bank and they're both earning, a husband and wife earning 200 grand a year each or something, no kids and no debt, yeah, laughing, I'd write your home loan in 5 minutes, but it's not actually that exciting.
Take money for 20 minutes for sure.
They don't exist either. Yeah, they don't exist. It'd be nice if they did, but they don't exist. So, I don't know. The worst part is, man, frustrating part of my job overall is dealing with banks, but
yeah. Mate, well, like last one, what's one word that describes the lending climate at the moment?
What's a word for tough but getting easier? Let's just say tough. It is tough out there. Borrowing money is tough at the moment, for sure. Tough, yeah, there's no BS about that. Yeah. As much as I try and help people, it's definitely tough. Yeah. But not to say don't do it. It's possible.
Well, it's definitely getting better, I think. And I think and people are getting a little bit more confident in the market, and I think it's a good sign.
Yeah.
Like
100%.
Ignoring the political climate, I think at the end of the day, people are in a good place.
Yeah.
I think so. So, mate, honestly, thanks for hanging out with me again tonight.
It's been the best.
It's been so good. I really appreciate it. We'll have to get you back on.
Love to.
Guys, thanks for coming out. Thanks for watching again tonight. Thanks for spending some time on the lounge. Again, hit us up on any polls, any questions, any emails. Hit Nick up directly if you have any questions at all. We'll see you again.
Thanks for listening to this week's app of The Lounge. To make sure you don't miss out on the next episode, hit subscribe. We'd love to get the message out to more homeowners like you. Make sure you leave a rating and a review, and we'll see you on the next app.